Late one evening, while most people were focused on regular headlines, something unusual was happening inside the financial system. The Federal Reserve quietly moved to inject emergency liquidity into the market. There were no dramatic speeches and no loud warnings, just billions of dollars flowing into the system to stabilize something most people never even noticed. But whenever the Fed suddenly adds liquidity like this, experienced traders immediately start asking the same question: what exactly went wrong behind the scenes? And more importantly, who is about to benefit from it? Because emergency liquidity injections are never random. They usually appear when something inside the financial system begins to tighten. Sometimes it's stress in the banking system or pressure in bond markets, and sometimes it's a hidden chain reaction spreading quietly through institutions. Policymakers try to contain it before it becomes visible to the public. Before we go deeper, take a second to like the video and subscribe if you enjoy clear explanations about financial systems. Your support helps the channel grow. It allows Iron Ledger to keep uncovering hidden forces behind global markets. Now let's start with a simple question. What does liquidity actually mean? In basic terms, liquidity is the ability to access cash quickly. Banks and financial institutions rely on this constant flow. In a healthy system, banks lend to each other overnight. Businesses access credit easily and markets function smoothly. But when fear enters the system, things change. Banks become cautious and lending slows down. Institutions start holding on to cash. That is when liquidity begins to disappear. When liquidity dries up, the entire system feels pressure. Markets that once worked smoothly become fragile. This is when the Federal Reserve steps in. It acts as the lender of last resort. It provides short-term funding to banks and institutions. The goal is to keep markets functioning during stress. This can happen through repo operations or emergency programs. Special liquidity facilities may also be created. To the average person, this may sound routine, but to market watchers, it signals something deeper. Sudden liquidity injections often mean hidden stress. Something inside the system is under pressure. Think of it like water flowing through pipes. If pressure drops, more water is pumped in quickly. The goal is to stabilize the flow before the problem spreads. Central banks operate in a similar way with money. But here is where things get interesting. Liquidity does not reach everyone equally. Certain institutions receive support first. Large banks and financial firms usually get early access. This creates an important question: who benefits the most when liquidity floods the system? Historically, large institutions benefit first. They use funds to stabilize balance sheets and reposition investments. But there is another side to the story. Liquidity injections can also move asset prices. Stock markets may stabilize and bond markets may come down. Risk assets can regain confidence. Prices that were falling may begin to rise. This creates opportunities for those already positioned. This is where institutional incentives come in. Large players closely watch central bank behavior. They monitor interest rates and funding stress. Small signals can reveal future actions. When they expect intervention, they adjust early. They position themselves before the wider market reacts. This doesn't mean anything illegal is happening, but it shows how complex the system has become. Another key factor is information flow. Large banks and hedge funds analyze central bank signals constantly. They study speeches and economic data carefully. Even subtle wording changes can matter. These insights don't require secret leaks. They come from experience and close observation. But the impact can be powerful. Early positioning can lead to major advantages. If liquidity enters later, they are already prepared. Prices rise while they are already invested. Meanwhile, ordinary investors react later. By then, much of the move has already happened. This creates an uncomfortable debate. Are interventions meant to stabilize the system, or do they also protect specific institutions? The answer is complicated. Central banks argue they protect the economy. Preventing bank collapse avoids larger crises. If major institutions fail, credit freezes. Businesses struggle and unemployment rises. From this view, intervention is necessary. It protects the broader system. But critics raise concerns about moral hazard. Institutions may take bigger risks expecting rescue. This tension has existed for decades. Every crisis brings the same questions back: who truly benefits from these actions? And who ultimately pays the cost? Another key piece is the bond market. Government bonds are the backbone of global finance. Banks use them as collateral and investors trust them as safe assets. Central banks rely on them for policy transmission. But when stress appears here, problems spread quickly. Interest rates can spike unexpectedly. Institutions may struggle to finance positions. Liquidity can disappear from critical markets. In those moments, central banks act fast. They inject liquidity to restore stability. This may explain recent emergency funding moves. Policymakers want to stabilize the system quietly, but timing sometimes raises questions. Liquidity often appears at critical moments, sometimes just before markets fall further, or when institutions face heavy pressure. Observers begin asking deeper questions. Did some players understand earlier? Were certain institutions better prepared? These patterns attract attention. There is no clear proof of wrongdoing, but uneven access to information shapes outcomes for viewers on Iron Ledger. This is fascinating. Central bank decisions influence trillions of dollars. A quiet action can ripple across global markets. Stocks, bonds, and commodities all react, yet most people never notice. The system operates quietly behind the scenes. Modern finance is a complex network. Banks, funds, and governments interact constantly. Stress in one area can spread quickly. Policymakers try to contain it early. Sometimes they succeed quietly, other times deeper issues take years to appear. That is why liquidity injections matter. They reveal hidden pressure points. Whenever they appear, analysts ask deeper questions. What triggered this move? Who received support first? And what happens next in the market? History shows central bank actions leave fingerprints. Markets react long after the event. Prices adjust over time. Investors reposition and institutions adapt, and the cycle continues again. The system resets and prepares for the next shock. Before we wrap up, I'd like to hear your thoughts. Do these actions protect the system or large institutions? Share your opinion in the comments below. Your perspective adds value to the discussion. If you found this useful, share the video. More people understanding this makes the conversation stronger. Thanks for watching Iron Ledger. Stay curious about the hidden mechanics shaping the global economy.